Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about why annuities are a perfect financial tool for dummies. I don't use that word dummies lightly, but there's a lot of folks here in the United States that just aren't financially literate. And just the simpler word I'm going to use for that is a dummy. You're financially illiterate and you don't know what to do with your retirement savings. So we're going to go over why they're a perfect fit, and we're going to be as blunt as possible. And our goal is, by the end of this, it's going to help you decide whether an annuity is a good fit for you or not. In my professional opinion, going into 18 years of doing this, talking about annuities, studying annuities, selling annuities, I don't know of anything else out there in America that does a more efficient job for the distribution of retirement savings out there. And that includes comparing it with financial advisors managing your money. Okay, so we'll talk about the annuity. The dummy version of the description is an annuity is it is your automated financial advisor. Okay, you're going to be able to accomplish not everything, but a good chunk of what a financial advisor can do without having to use any thought. It automates from the growth to the income distribution, to the death benefit to beneficiaries, long-term care, inflation, all those things. Like you don't have to be smart about it. It will do the job for you, and you don't have to pay a hefty fee for somebody to manage it. Okay, so if you're in that position where you're not quite sure, I don't know if I want to invest money with a financial advisor, especially what's going on with the markets these days, or I don't want to be outsmarted, or I'm a little nervous about being scammed by somebody. The annuity is a contract with a financial institution that will overcome those problems and take away those fears. Okay, so first thing I want to talk about is you don't have to be smart about investing. When you buy an annuity shifts the responsibility from you to the insurance company. You're not picking stocks, you're not timing the markets, you're not managing risk. Most investment strategies, assume that you have the knowledge and the discipline to manage that money in the market. Annuities assume that you have neither, and you get to protect yourself accordingly. So what that means is if you buy a fixed annuity, you're going to get a guaranteed fixed interest rate. Okay, so there's no investing there. It's like buying a CD at a bank or a credit union. Okay, you use a fixed index annuity. You get the choice of getting a fixed interest rate, or you can earn interest based on the performance of a stock market index like the S&P 500, NASDAQ 100, or the Dow Jones. And you're not in the market. The insurance company uses those indexes as a measuring stick to determine how much interest that you earn each and every year. So there's none of this, hey, I have to take a look at my portfolio when I retire, or my 401k, or my 403b, or my thrift savings plan, or my pension. I don't have to worry about it. If the market crashes, you just don't earn any interest that year, and your original investment is protected from that because you're not in the market. So however, if you are purchasing a variable annuity, you're very well exposed to that. And that takes a little bit more discipline, or you need to hire a financial advisor. But if you choose a fixed or fixed index annuity, and a fixed index annuity, in my professional opinion, solves most of the problems you're seeking without the hassle or worry about losing money in the market. No, you're not going to get as much upside as a variable annuity or being in the market, but you're going to get a good chunk. If you use the right person to find you the right annuity product, you can average 5 to 7% as an average rate of return while getting guaranteed income. So, and protection from a stock market crash, and paying lower fees. So in terms of investment, you don't have to worry about it. You can't lose money. That's another one. Fixed index annuities, it protects your principal, so you don't have to worry about, hey, am I going to lose all my money in the stock market? You don't have to worry about that. You get a paycheck for life. So if you buy a fixed or fixed index annuity or a variable annuity, and you add a guaranteed lifetime withdrawal benefit, not annuitization, you add this lifetime income rider, it's going to distribute a paycheck as if you were still working to the day you die, even after the annuities account has run down to zero. It'll even cover 2 lives. So if you're married, you and your spouse can be on this annuity, and it will pay them the same, both you and your spouse, the same paycheck until both of you die. And then when both of you die, whatever's left in the account will go down to beneficiaries in a lump sum. So when you're using a financial advisor to manage your money, they're managing your money in the stock market, and then they're going to distribute 4% out a year to start off with, and then they're going to adjust each year for inflation. And they're juggling 2 things. Hey, how do I maintain this similar paycheck and keep up with inflation while trying to grow the portfolio? The annuity takes care of all that. It's going to allow you to grow your portfolio. It's going to allow you to get the automated income, and it's going to cost you at a fraction of the price because you're not having to pay somebody to manage the money. Let's see, what else? Going back to inflation. So where you're paying a financial advisor to manage your money and keep up with inflation. Well, if we're in a volatile market, it's super hard, because that means you have to have this balance of, okay, well, if the market's going up and down, how do I keep the paycheck steady? So meaning a similar paycheck, and on top of that, increase it. Well, if you bought an annuity with a inflation adjusted income rider, you can earn, you can almost guarantee a increase to your paycheck each and every year through a fixed interest rate. So if you get a certain amount each year and you allocate the fixed interest bucket to it, you're going to get that guaranteed increase each year. Some other ways that you can get increases as well, if you choose to, is either based on index performance. So whatever interest you earn each year, it applies to your account balance, and it also applies to your paycheck. So, if you got a 5% return one year, you get a 5% return on your account, like anything out there. But you also get a 5% increase to your paycheck that year. And the cool thing about the inflation adjusted annuities is that once you get an increase to your paycheck, it can never go backwards from there. That is your new floor, your new minimum going forward. Where if you have your money being managed in the market, you're getting a percentage of what your portfolio is. So if you look at 2008, 2009 and the Great Recession, if you had $1 million and you lost 40% of it, you got $600,000, right? And then you're getting 4% of $600,000, not 4% of $1 million. Yet an annuity, it would be 4% of the $1 million. And you would start out the gate with a higher payout percentage, and you would get higher increase opportunities going forward. So in terms of a inflation rider, I think it's far superior. Next thing that annuities are good for dummies, you really don't have to be disciplined on much. The annuity takes care of the heavy lifting for you. The only area of an annuity where you have to be disciplined is you've got to discipline yourself from not cashing in the annuity early. So a huge con for an annuity is that they have what's called surrender periods. Excuse me. And in the surrender periods, there's surrender charges. So I want you to think about like when you go rent out an apartment and you sign a lease. Well, if you cancel a lease, then you're going to pay some sort of early termination fee. That's what a surrender charge is. So as long as you're okay with being in that contract and you can keep yourself disciplined from just following the plan and adjusting your life to the plan that the annuity dictates, then you should be perfectly fine. But if you're one of these folks who is like, hey, I want to get this annuity, but the market's going back up and I want to cash it in, or the market's tanking and I want to cash it out, just stay away from annuities. Go do something else. Tax deferral, with annuities, you can roll over your 401ks, your 403bs, your thrift savings plans, your pension plans into an IRA annuity. So no taxable event happens there. And you'll continue to get that tax deferral and triple compounding on your money. If you have a pension, you can use annuities you can use an annuity as a pension in two different scenarios. Scenario one is, hey, I currently own a pension and I don't want to give up control over my money. So when you have a pension and you take the monthly benefit, you are relinquishing all control of your money to the insurance company. You're annuitizing that contract. We're not fans of that. You should be able to keep control of your money. So the way that you do that is you roll over the pension to an IRA annuity. You now have control over your hard-earned retirement savings, and you can add the income rider and get a similar or better lifetime income as you would with the pension, which leads into the second scenario, which is, hey, less than 20% of companies in America offer a pension, so you can use your 401k, 403b, all your retirement accounts, roll it over into an IRA annuity and add the income rider, and now you have a personal pension plan that you control, and you can have the choice of sticking with it or changing your mind in the future, as opposed to having an employer dictate how your money is controlled. Death benefit, look, just name a designated beneficiary or beneficiaries on your policy, on your application, or you can change that as frequently as you want. But as long as there's a designated beneficiary on your annuity, when you die, it will avoid probate in most states, and it'll go directly to those beneficiaries without any sort of outside entity like probate courts getting involved or the estate getting involved. It will go directly to them, just like life insurance will. You'll avoid another reason why annuities are great for financial dummies is you avoid costly investment mistakes. You remove all the decision making. Annuities eliminate common investor errors. When investors are managing their money or investing their money in the market, if the market underperforms and you don't know what to do, you're in a lot of trouble, right? And then by that time, it's too late. You don't have to worry about that. You also don't have to worry about your financial advisor or your money manager making bad decisions based on bad behavior. And you don't have to worry about panic selling or chasing returns or over trading or finding ways for them to charge you more fees. Because when you get a financial advisor or a money manager, good market, bad market, in most scenarios, you are paying a fee. So if you're losing money, you're probably going to be still paying a fee because somebody's doing a job for you. An annuity is simple compared to everything else. It's just, there's no rebalancing, there's no research, there's no constant monitoring. It really is a set it and forget it. Easy to understand income, low maintenance. You buy an annuity, you really, if you buy specifically a fixed annuity or a fixed index annuity, it is set it and forget it. There's no money in the market. So you get a letter on the 11th month every year, your anniversary date at the end of the year, and it asks you how you want to allocate your money. That's basically it. So you set up a profile, and there's not really much being done because the insurance company is taking care of all that for you. I think just finally, it's just you're going to get, if there's anything that you get from this video, just summed up why annuities are great for dummies is, number one, you're able to earn interest. Number two, your income is fixed, so meaning it'll stay the same or it'll be better depending on your payout. And it's automated. So there's no worrying about contacting a third party. You're just going to put in your bank information at the insurance company. They're going to deposit those checks. Your beneficiaries are taken care of. So there's not going to be this use it or lose it scenario. Inflation, same deal. Long-term care. What you give up, just so you know, is you're not going to get all the upside in the market. So if that's what you're into, don't buy an annuity. Okay. Even if that includes variable annuities. Variable annuities are just too expensive for what you get, and you're better off just being in the market. You are not going to have, you're going to lose control. That's not the word. You're going to pay a price if you want to get out of that contract early, right? So if you want to be in the market and you want to move money around on a daily basis, annuities aren't a good fit for you. Okay. If you like that thrill-seeking ride of putting your money in the market, annuities are not a good fit for you, although they would be a good safety net, as a plan B or a backup plan if you are day trading. But outside that, I don't see anything out there that does a more efficient job. When I say more efficient, I mean predictability, higher income payouts, protection and safety. That's efficient than anything out there in terms of financial tools in retirement. So I hope that answered your question, at least gives you a clearer vision of if an annuity is a good fit for you. If you got questions, go to Google, Bing, Yahoo, type in the Annuity Expert. We'll show up. You'll come here. I have my annuity basics page. I have a whole learning lab on annuities. I mean, you can answer every single type of question that you could have. Take a look at today's fixed annuity rates. And then you can contact us at 770-755-1565. I hope this answered your questions. Like, subscribe, comment. If you have a question and you don't want to come talk to us, leave a comment. I'll answer that question personally. But I hope that answered your questions about annuities. And if you have questions, contact us, and we'll catch you on the next video. Thanks.